When it comes to the economy, growth is meandering along, but a few events in the months ahead could shake things up. Steve Liesman explains.
In the second half of 2017, September will stand out as the month to remember when it comes to the economy. That's when the administration promises to deliver its sweeping tax plan, when the U.S. might hit its debt limit, and when the Federal Reserve could begin reducing its $4.5 trillion balance sheet. Most important, by the end of the summer, we should have a better fix on three critical economic gauges. First, growth. The U.S. started the year with lackluster GDP of just 1.2%. That looks to have accelerated in the second quarter to near 3%. By September, we should know if all that post-election enthusiasm by consumers and businesses has turned into post-election sales at the mall and investment from companies. So far, the results are mixed. Second, the unemployment rate. It's fallen to a 16-year low of 4.3%, and many economists say this is full employment. But it may have further to run, especially if growth picks up. But if the rate goes too low, the Fed could begin worrying about the third big item on the list. That's inflation, or the lack of it. It's been moving away from the Fed's 2% target for the past 3 months, dragged down by lower oil prices and a decline in telecommunication costs. Fed officials say they expect inflation to pick up in the months ahead, but some are starting to get nervous. If inflation doesn't pick up, that will likely put the kibosh on a third interest rate hike this year from the central bank. The best guess? Growth in the next couple of months will look a lot like it did in the first half of the year. Despite ups and downs in GDP, it's likely to average right around 2%. Any impact from fiscal policies out of Washington, that's a story for next year, not this one. For Nightly Business Report, I'm Steve Liesman.